All right, officially welcome into this 9 cash flow levers training. I'm Alex Engar, along here with my business partner, Will Boyd. We got Scott from our team as well. And we're going to be sharing insights from working with hundreds of different business owners in stabilizing cash flow and getting it to a spot where you feel like, this is the business that I intended to create in the first place. This is going to be a fairly interactive training. We're going to be asking questions. We're going to be fielding questions. And I've got an hour blocked out for you over the next little bit. I'd really encourage you to be present, which means share your camera. Okay. I know that it's really easy to be on a Zoom call and be like, I've got something else to do. I'm working on this in the background. You'll get so much more out of this if you're not trying to dual task and if you're present. So if you're on here, I want you to flip your camera on for accountability more than anything. I'll keep mine on too. Okay. And I want you to think about, how do each of these principles apply to my business? What is it that I need to be changing right now? We have people from all over the country here, and I'm guessing lots of different types of businesses. Will you just share in the comments real quick what type of business you run? And I can give more specific examples as we're going through this, given your business model. We've worked with people from PT like Jordan, all the way through construction management, rental property management, brick and mortar locations. I was going to say accounting. We actually do have accountants. We have tax professionals. We have product businesses, manufacturing businesses. We have digital agencies, marketing agencies, solar, roofing, pool businesses. We've worked with a bunch of different kinds. And we started seeing these patterns crop up within each of these businesses where they needed to have something be different about their cash flow and they weren't sure what. And so we started seeing, you know what, there's these similarities over and over and over. And these 9 cash flow levers that we're going to talk about today became really apparent as we worked with all these different types of businesses. And so we got a pediatric OTPT, speech therapy. Awesome. We got Ross in an entertainment business, Brandon with an indoor sports facility. Very cool. We got another physical therapist. We got some PTs in the house today, non-medical home care for seniors. Good stuff, Dwayne. We'll give a quick intro to us so you know the context of where we're coming from here. Both my business partner and I, Will, are former physical therapists. And I say former, it's been quite a while since we've actually put our hands on a patient. You wouldn't want us treating you at this point. And we started getting into the marketing world back 5-6 years ago. We got really good at helping people attract clients, learn how to sell, and we got really good at helping people make money. We were running an agency and a coaching business, helping people launching online products and doing all these marketing things. And we started seeing that, gosh, we're pretty good at helping people make money. But we started getting these little comments along the way, like, I'm still so stressed financially, or I had this huge tax bill I wasn't expecting, or man, I'm still not taking home what I want to, despite people making a lot of money. And we started realizing just making money doesn't equal keeping money. And I don't know if y'all have felt that, but in our business, as we started to make more money, it was like, gosh, I really want to make sure I can actually take home more. And so we started just seeing this pattern of business owners not having the financial understanding to be able to take care of their businesses. And really, there were a few key things that stood out. We went through this phase 2 in our business where at first we thought, hey, can't we just hire this off to someone? Can I just get a bookkeeper? Can I just have an accountant? They'll tell me what I need to do with my money. We thought that we could just delegate the most important decisions in our business when we didn't have a fundamental understanding of how money worked as business owners. So the first lesson was that we couldn't just delegate this stuff, and neither can you. Even when you're at a spot where you have a bookkeeper, you have an accountant, they're doing all their stuff for you, they're still not going to tell you, hey, this is exactly how much you should pay yourself this month. Hey, this is how much you should leave in reserves in the business. Oh, this is how much you should pay off on that debt. Until you get to the point where you can really have a CFO in the business, which is at a fairly high revenue level for most business owners, you need to be the one in charge of actually making financial decisions. So you better have an understanding. So that was the first thing. We couldn't delegate this. Second thing, as we started looking at this was, gosh, we didn't have the right systems in place. It was really messy. We were just shooting from the hip as we were making financial decisions. And so we didn't have a process in place for how to think through the money. So we'll show you a little bit behind the scenes of our thinking process today as we look at this. And then the last thing was we just didn't actually understand how to read the documents that we were getting from our different financial providers. And I see a lot of business owners who think, you know what, that bookkeeper is just totally going to take care of me. They say that my profit is great. I meet with them monthly and they say, oh, your profit's looking great, but I still don't feel like I have any money. That is such a common thing for people to feel like I've made all this money and I have no clue where it went. So today we're going to look at all the places that money can sneak out of your business and how we can start taking control over that piece by piece. Cool? Will, anything else you want to add, my man, as we dive in today?
Let's get into it.
Sweet. David Cardilano, good to see you on here, dude. All right, so let's hit this. I want you to pull out, this is the spot where you might want to pull out something to take notes. And we're going to go through, I promise we won't do too much math today. However, understanding the math of your business is what frees you up to be able to take home all the money that you want. And so we need to talk about it just a little bit. You may want to pin my video. I know it's, there we go. I think I forced it on you. Can you all see the screen? Okay. Thumbs up. Sweet. All right. So first, as we look at cash flow in the business, we need to understand the difference between profit and cash flow. And so if I were to pull up a fake profit and loss statement here that we pulled from good old Google, and we look at a profit and loss statement, we have a couple different things here that we need to all be on the same page about. First one is income, right? It's just, hey, any money that I make in the business is coming in as income or revenue. The next section is always cost of goods sold. So whatever you actually sell, there might be a direct cost associated with it. Sometimes it's materials, maybe it's direct labor, but for many businesses, they don't even have a cost of goods line. If it's a PT practice, you might not see that. If you're a direct service-based business, you might not have it. If you have some products in there or you've got subcontractors, you would, okay? And then we have all of our other expenses that kind of funnel in through the bottom here. And then out the very bottom, there's usually a big old hard line right here. And we have net income underneath that. And so we have a lot of owners who look at that net income number and they say, I should be doing just fine. Where's my money? And what we're going to talk about today, the first 5 of these cash flow levers are things that affect this P&L. So if your profit and loss statement is showing net negative or fairly break even, or you don't have a good net profit margin, if you're not significantly above at least 10% net profit, then we're going to focus on numbers 1 through 5 here as we're looking at these different levers. If, on the other hand, you feel like, I'm making plenty of profit at the end of the day, but I don't see the cash, well, then we're going to be looking at things after number 5. Okay. So it's just good to start seeing, how is this affecting me and my numbers? I'd love to know in the comments right now, with the stage of business you're at, do you have a bookkeeper or are you doing your own books? I'm just curious to see where people are at because it'll affect a little bit about how we talk through this today. When we're working with business owners, I would say most of the people we work with have bookkeepers. If you don't have a bookkeeper and you're doing more than like 10K a month, you've got to have one. You just got to. And we work with business owners who are doing north of 10 million a year at this point. And I'll tell you, they have bookkeepers, they have accountants, sometimes they even have controllers. But if the business owner doesn't understand this stuff, they're still completely driving blind. Good. I'm glad we got a lot of people with some bookkeeping. We got a few that are working on outsourcing that. Glad to hear it. Okay. So let's dive into these different levers. This is the biggest one. It's why it comes first. And it's probably the beefiest that we're going to get into today. And this is pricing. So this affects the very top line of our P&L, right, as we're looking at income. And the very first one being, sometimes it's as simple as, let's go make a 5 to 10% increase in our prices across the board. Okay. So depending on the type of business you have, I want you to think about, when was the last time I raised my prices? And when we do this training with our clients, we sit down one-on-one and we go through this. We often find that, oh gosh, it's been a year and a half, 2 years since I adjusted my prices, right? If it's been a while, then it might be as simple as do a 5 or 10% across the board increase on all your prices. That's the really simple version, okay? Second one is, we might really need to dig into, how are you putting your offer together around what you're selling? And can we either increase the price of our offer by making our offer better? Maybe it's getting better at selling it. Maybe we need to bundle things together so that we can sell at higher prices. Or maybe we really need to look at the target market that we're selling to. So there's a lot of businesses who might be saying, I'm trying to sell to everyone. And so because of that, I gotta have low prices. We'll look at this in number 4, but you don't have to sell to everyone. So I want you to think within your business, if you were selling to the top of your market, who would that be? And how would your offer or service need to change based on that? So how can we increase pricing? This is one that I find almost across the board. People need this. They need to change their pricing. And I think too many times people fall into the game of, oh, everyone's going to balk at my new prices. And when there are minor price adjustments, oftentimes people won't say anything. When there are large price adjustments, it means that we need to be able to market or sell that thing better. And we've gone through that as a business. We used to have our very first program ever was a $97 course. And we felt so bad charging $97. And it was so interesting as we changed from the mindset of, oh, I've got to sell at the bottom of the market to, well, what if I solve a bigger problem, package it in a better way, and go after a larger problem with someone who can actually afford it. It changed a lot of things for us. There's a really great book called $100 Million Offers by Alex Hormozi that if you haven't read it, might be worth looking at in looking at how to change your offer and pricing. David, I know you're all over his stuff. He's got some good stuff. Okay. Number 3 is pass-through fees. This one is a really big deal. As I sat down and did this on Wednesday with a client, they run a tire shop, a chain of tire shops. And as we were looking at these pass-through fees, we found $200,000 of annual profit that they were giving away because they didn't have the right pass-through fees in their structure. And so we looked at it and said, hey, what else are either, this is the easiest way to look at it, what else are, what other costs are your competitors passing through to their customers? So it might be something like as simple as, hey, if they use a credit card, we will charge an additional 3% fee. So there might be credit card processing fees here. So maybe there's a 3% upcharge on that. I'm actually seeing that a lot more now as a consumer when I'm buying stuff online, and they say, oh, now there's this 3% fee if you pay with a credit card, or otherwise you can send us an ACH transfer. So there's credit card processing fees, 3% to the bottom line, right? Across the board. Imagine if you could, with no other change, we immediately change our profit margins by 3% because of that. Could be worth looking at. Other ones are, for example, in our property management business that we work with, they were not passing along fees for helping clients set up utilities. And there's a number of little things in your business that you're probably paying. The industry standard is customers pay for, clients pay for. So think about that. What other things could I pass through that would be worthwhile, that might be 1%, 2%, or 3% little things, but it adds up over time. And I'll tell you, take this one seriously, because there's probably a lot of profit sitting in your business just leaking out of it because you aren't passing through the right things. Okay. We even had someone, as we were diving into their finances, they didn't realize that they hadn't been charging sales tax. They'd been paying sales tax, hadn't been charging it, right? And so there's little stuff like that, that as you can think through, it starts to stack up big time. Last one is say no to non-fits. What do I mean by that? Well, there's a lot of people who aren't fits for your business that you're trying to squeeze in and fit in. And so your pricing and how you're thinking about your business makes it so that you're charging a lot less overall. As we looked at the growth of our business, we started seeing that we can't serve everyone all the time. And yes, you can have, as you get more advanced in the business, you can have a suite of different things you sell. Maybe you're a product-based business and you do sell a whole bunch of different things. I want you to focus on what are the most profitable things in my business. And as we sit down with clients, we have a very one-on-one process where we're going through and looking at their different offers and services, and we're looking at their different margins across what they sell. And with one of our electrician clients, we sat down a couple of weeks ago and we were looking at how much they're making per hour of their team's time, right? And we started bucketing it into 2 different categories, our high margin stuff and our low margin stuff. And so we looked at this low margin stuff versus the high margin, and there was a 5 times difference in end of net profit between the low version of their services and the high version of their services, or the margins. So we started saying, gosh, why are we spending so much time over here on the low margin stuff when for every hour that we spend over here, we get literally five times the profit. It was wild for the same amount of time, effort, and materials. And so in a case like that, we might be adjusting our pricing over here on the low margin side, or we might be pushing more of our marketing and our efforts over to the high margin side. But if you don't know what your margins are, then it becomes really difficult to make these decisions. That's what we do. It's part of what we do within our program, CEO Finance Academy. And so from a high level, pricing is the number one thing that I would start with if you're really hurting from a cash flow standpoint. And I would imagine that all of you have one thing on here that you could go adjust right now. So I would love to know in the comments, which of these do you feel like is next for you from a pricing standpoint? 1, 2, 3, or 4? Do you think that you're due for just a broad across the board increase in pricing? Do you think that you could maybe look into how you're packaging your offer, or maybe the target market that you're going after? Is it pass-through fees, or is it saying no to non-fits, or maybe looking at your high margin versus low margin products or services? So we got 3, 3, and 4, pass-through fees, a lot of pass-through fees. Cool. It's small stuff that we don't think about as owners that really adds up. And everyone gets so nervous that their customers will push back on this stuff. And I'll just tell you, as I look at this from a customer standpoint and look at the things that you pay for and ask yourself, am I bugged that they're including that as a cost? So for example, we've got a rental property, we have a property manager, and I was looking at their pass-through fees when I renewed my contract with them a couple months ago. It's like, hey, we're going to charge you for getting the new tenant in. We're going to charge you for, if the toilet goes out. We're going to charge you for if we need to have the lawn mowed. And it was all these little pass-through fees that it was like, oh yeah, that makes sense that you would charge me for that service. Totally makes sense. It's a cost to you. I get it. And it's something that I think we get too worried about as business owners. So that's number one, pricing. Okay. Let's talk about number 2 here with payment terms. So the first one is a big one. It's how can I get paid sooner? We have a lot of people who, as they look at their business, they come in, they say, I'm making a ton of money. I'm making hundreds of thousands or maybe even millions a month, but I don't get paid that money. I've got a ton of accounts receivable, right? And so the biggest problem for a lot of larger businesses is that they have this huge amount of revenue, but they're having to put all the money out, right? So they're paying everything now, and then they have to wait 60 days before they get paid into the business. That lag time can be a killer. And if you're in a business like that, you probably know what I mean. It's painful when you are owed money and you got to go chase it down. So you got to ask yourself, how can I go make it so that I can reduce this lag time between when I get paid? There's a couple ways to do this. One is we can offer upfront incentives for people to pay early. For example, in our construction-based businesses, we have a lot of people who are sending out bills to their clients, and then they're waiting 30 or 45 days. And as a customer, again, put on your customer hat sometimes. As a customer, when we were building our house, and I would get those bills for our lumber, which, by the way, the most money I've ever spent in my life was on lumber for building a house. Holy crap. They would offer a 2% discount if I would pay by the 10th of the month. That was their thing. Hey, we'll give you a 2% discount if you'll pay by the 10th of the month. And do you know how quickly that bill rose to the very top of my to pay next list? I never missed that payment being first because they incentivized me to pay early. Now, whether they built in a 2% margin on their total price or they actually took a 2% hit, I don't know. All that matters is they got paid first out of everyone, and they happen to have the largest bills. So if you're in a business where you get paid last, or it takes a long time for people to pay you, look at how might I incentivize people to pay up front. So it might be a 2% paid in full discount, right? Or a 2% early pay discount. It might be something like, hey, the standard for us, and we've got a pool business that is so smart in the way that they handle payments. We've got a number of different pool businesses that we've worked with. And on one spectrum, we have people who are owed money for 30, 60, or 90 days, right? They install the pool, they bill the person, and they're waiting on the payment. Problem is they've put all the labor dollars out already, and now they're sitting there in a cash flow pinch. On the other side of things, we've got our really smart business owners who set a culture or an expectation with their clients that here's how we work with people. We'll give you a bid. We'll take your card number. Once you approve it, we'll take your card number. We'll charge you. And on the day that we show up to do the thing, we're charging you. So they have the credit card number before they actually perform the service. And they charge the customer on the day that they perform that service. And they never have that cash flow lag. Now, I get that not all industries may be able to do that, but I want you to think about how can I physically get paid sooner? The other thing is sometimes we got people who have just a huge AR list, accounts receivable, where people owe them a lot of money. And it's simply a question of have someone who will be that dog, we call it, to go hunt down that AR for you. We had one business that came in and they had over $100,000 of late money that people hadn't paid them. I said, well, how did they get so late? I said, well, we just haven't really asked. So I said, okay, who do you have in your company that is good on the phone and can go make some calls to get payments collected? And within a month, they had collected $89,000 of that 100,000 because they just had someone whose job it was to go make those calls. A lot of times you get busy with things. If you're a solo owner, then you're maybe the one doing it. If you've got a big team, maybe it falls through the cracks and you don't have someone whose job it is to hunt down money that you're owed. But man, that was worth it. And I said, look, it was at the end of the year. So I said, let's incentivize that guy by giving him a percentage of everything he collects. So they gave him something like, I don't remember if it was 1% or 1.5% of everything he collected. And he got a nice Christmas bonus. And so how can I get paid sooner? The other way to think about this, if you aren't in a business like construction, maybe you're in a consulting or an agency-based business, maybe if you're in a healthcare setting and you're cash pay and you have control over this, you can look at how can I structure payment plans to incentivize people to pay early? So if you have a package that's, let's say, I don't know, a $2,000 package, and it's $2,000 up front, or you say, hey, or you can make it, in 3 payments. And let's see, quick math here, 2,000 over 3, that'd be $667 times 3. Well, nobody's incentivized to pay you early like that, right? So instead, what if I were to go in and say, you know what, you can either pay us, let's call it, I don't know, $767 for 3 months, or you can save $300 and it's only $2,000 upfront. I remember when I went and got braces way back in the day, our orthodontist did this. He said, hey, it's either going to be, it was a total of like $6,000 if we paid overtime, or if you pay up front, there's $1,000 early pay savings. And so you can position this by looking at, you can either pay this, or if you like to save money, you can save $1,000 by paying up front. Which payment option works best for you? And it's just a framing question. And now all of a sudden we've incentivized people to pay us up front. And there's a big difference for business owners who can collect up front versus dripped out. And we've seen that in our own business as well. Okay. So that second one, payment terms. How can I make sure that I get paid sooner and I'm not dragging out cash? If I have people who owe me money, how can I go hunt down, especially those big ones? And how can I incentivize people to pay sooner? Okay. I'm curious, in your business right now, do you have some way to incentivize people to pay earlier? Yes or no? And does it work for you? Well, you just pop in the comments. Do you have some way to incentivize people to pay earlier? And does it work for you? I just know that this was, Will said this helps so much with cash flow. 100%. I mean, this has been the biggest game changer in our business from a, I'll just say calmness about the business, like a sleep well at night about the business, is getting a real handle on cash flow and getting paid when you're supposed to. And here's just one thing to think about. Sometimes people feel bad for charging more for payment plans. First of all, mortgages, credit cards, any other debt, they all charge for payment over time, every single one of them, right? But then the second piece is there is a real cost to your business of not getting paid over time. One, in that it makes it harder for you to actually operate the business. And a lot of business owners get into debt because of this exact situation. So they then are paying the interest, right? And all of a sudden their business gets much more expensive because they have to take out crappy loans. But then the second piece of this is there's a real cost to it as well, because if you have someone on payment terms, as you scale that up, I guarantee you that someone's card is going to fail because they changed card numbers, or because their card got compromised and got frozen, or because their card expiration date passed, or maybe they run out of money, or they have low funds in their account that day. At some point, as you grow this out and you're doing long-term payments, you're going to have payments drop and you're going to have customers drop. And there's a real legitimate cost to that. So you shouldn't be the one on the hook to shoulder that burden. Okay, let's see. We got some interesting comments here. We've got some yes and yes. We got yes, prepaid packages, and yes, it works. Good to hear, Jordan. Trish says, yeah, only packages. That's only 15%ish of business. Cool. So I would look at how can we shift to, rather than, if I'm a healthcare provider, I might not necessarily want to just get paid visit to visit. And I might not want to just get paid from an hourly standpoint where my clients or my patients are saying, oh, I only pay per visit, right? I want people to pay per outcome, not per hour. So I want to change how I'm thinking about payment and how I'm offering that to my clients or patients. Okay. All right. That was number 2. So I want you to think about, from this, what can I go do in my business? Now, we spent the first half hour on just 2 things. I get that. So we'll go a little bit faster through these next ones, but those are the 2 biggest ones that I see hurting people. Okay. The third one is the one that everyone kind of just expects. And I'll just tell you, as we've worked with larger and larger and larger businesses, we first started working with business owners who were in the kind of $10,000 to $25,000 a month range in terms of revenue. And I thought, as we started working with bigger and bigger and bigger businesses, now we're working with those that are doing more than $1 million a month. I thought that we would see that, oh, their business is going to look so much better because they're doing so much more volume. Let me tell you that the trap of thinking I just need to sell more and that will solve all my problems, that is often not true. Because the more you sell, the more complexity the business requires. And if you don't have a handle on the finances with where you're at right now, simply selling more is not going to solve the problem. And so I give this sales volume number here with a big old caveat that this is not going to just magically bail out the business. Everyone thinks it will until they start to do it. And then they realize, oh crap, I need more fulfillment help. Oh crap, I need a larger space. Oh crap, now I got to have all this extra complexity in my business. And I see people fall into the trap of thinking that this will solve everything. However, I'm not saying that we don't want to sell more, right? Yes, it can help. And yes, this is part of growing the business. But I want to think about increasing your sales volume in 2 different ways, okay? There's 2 limitations on sales, fundamentally. Either there's an acquisition limit, meaning I just need to get more people in the door, right? I need to actually make more sales. So it's either acquisition or it's fulfillment. Meaning, if you're, especially if you're in a healthcare type of business, if you have a wait list, you have a fulfillment limitation, right? Because you have more people than you have spots. So I want you to put right now in the comments, do you think you have, and all of us have fundamentally either an acquisition limit or a fulfillment limit. It's one of those 2 things is limiting our business right now. Which do you think you have? Is it acquisition for you or fulfillment? Which one is most limiting? David says acquisition. Dwayne says fulfillment. Both, but more acquisition. Cool. We're going to look at both for a minute here. The fulfillment one is really fun to solve. It's so fun. And it's really easy to solve. We'll look at it here in a minute. From a financial standpoint, it's my favorite one. Let's look at acquisition for a minute. There's 3 ways that we can sort of solve the sales volume issue as we're looking at the acquisition side. Either I'm just physically selling to more people, right? I'm getting more actual sales in the door, or I am selling to those same people more frequently. So this might look like an upsell or a cross sell after they have, after they've finished working with me once. Might look like having some kind of back end program after my initial one, or a back end service or offer, or I'm just making more money per sale. Okay, so that's where we get into the bundling side of things, right? So for those who are in the acquisition phase right now, what do you think the easier, simpler lever would be to pull for you? Would it be to go get more people in the pipeline and make more sales that way? Would it be to sell more frequently or have other ways to sell to your existing clients? Or would it be to increase the dollar per sale that you make and not change anything else? Which one? More people, more frequency per person, or more dollars per sale? Which one? Because this may be one of the next focuses for you in looking at, if I've got an acquisition problem, then what do I do? We're at the spot where we have two things. I think we could sell more frequently, but we're really focusing on the pipeline. The more people, we spend a lot of money on advertising, and so we're flooding our pipeline through lots of different mediums right now. And at one point, we actually hit a fulfillment bottleneck, and so we solved that one. And now it opens up, and now we can put more acquisition in. So that's the acquisition side. On the fulfillment side, this gets really fun. So I would look at, for those of you that said fulfillment is the bottleneck for you or the squeeze point, what is your current bottleneck within fulfillment? And in order to do that, you have to be able to know your pipeline, right? So someone comes in and then they move to this step and then they move to this step. So maybe this is manufacturing. Maybe this is, if you're in a healthcare business, maybe this is, they come into the front desk and then they get an eval and then they get a treatment plan, right? Like, where is the bottleneck? Where's the limitation within fulfillment? And in a brick and mortar practice, you've got two types of bottlenecks. You have the space bottleneck, where you have a physical limitation on your space because you can only treat, maybe you've got 4 treatment rooms, 1, 2, 3, 4. And you might say, well, I don't have anyone yet in that 4th room, or I only have 3.5 full-time people there. Okay, well, then you don't have a space limitation. You have a provider limitation, or a person who is providing the service. So we need to go add another person. If you're in a brick and mortar location where you have all of your capacity filled in terms of space, then you have a space capacity issue, right? And then we're looking at either improving our space, adding on to it, cutting our space, divvying it up, or maybe it's creating a second location. But it's looking at, what is our current bottleneck and understanding how to go solve that next. Because if we're at capacity here, and it's like, yeah, all my providers are at capacity, or all my team members are at capacity, then I'm not going to grow the business simply by getting more people in the door. I'm going to grow the business by first solving my fulfillment limitation. And this is what we do with clients. As we get a real handle on their finances, we really start looking at, how do you grow the business next? What is the next step? And we look at team capacity. So with our property management client right now, yesterday, we're sitting there looking at each team member. Okay, your property managers, how full are they? What capacity are they at? When is your next hire given your growth rate? And so sales volume ends up being a really important lever, but we got to understand, is it a fulfillment limitation or an acquisition one? Okay. So again, I would be thinking in my mind, what is the next thing that I need to focus on within sales volume to sort of release that lever? Okay. All right. Number 4 here is cost of goods. There's a bunch of different ways we can dice this up. So we'll just look at these quickly here. It falls into 2 categories, either materials or labor, right? So on the materials side, how do I go make a difference? How do I pull these levers? Well, maybe there's different materials we can go buy from a different manufacturer that's cheaper. We have someone who prints a bunch of booklets, and they had not looked at their paper distributor for a really long time. And they went and shopped paper, and they found that they could save like 20% on their costs because they'd been with the same distributor for 10 years and the costs had gone up and they just hadn't shopped around. So they just went and got different materials, and we saved a significant amount right off the top without having to change anything else in the business. Sometimes it might simply mean buying in bulk. So if you have space and access to capital where we can go buy in bulk so we can get our prices down, that might be a thing. Or we have some people who are sitting on way too much inventory. And as we look at their inventory, if they're a manufacturing-based business or they sell some kind of product, we look at their inventory and say, how much do you really need? What's the optimum amount that you really need? And maybe we can spend some time eating through that existing inventory rather than buying a bunch of new stuff. If there's something that you had sold a lot of in the past, so you're holding a lot of inventory on it, but now it's slowed down or the market has changed, great. Maybe we're going to change our buying habits and put less out on those materials and put a focus on going through those existing pieces of inventory. For our product-based businesses, this one ends up being a really important piece. And if you sell, if it's e-commerce or retail, I'd be looking at inventory and see what's moving, what's not. And it's really having a good handle on understanding that. Okay. Second piece that's probably more relevant to those of you on here live right now is the labor side of things. And there's two options here. I can either hire cheaper or I can make my existing team more efficient. How? Well, I'm going to look at the processes that I'm putting them through or the tools that I give them. For example, right now, there are a number of wildly crazy AI tools out there that can help make your team significantly more efficient, whether it's through email communication back and forth, maybe it's blog writing. There's a bunch of different stuff out right now that is making the efficiency of teams so much better. And I'll just tell you, for our team, as we've been implementing a lot of this stuff, we found that yes, there are some tools, but even more important are the processes that we go through. And I find that this tends to be one of the places where owners get the most, I don't want to say lazy, but complacent is probably the right word. We just say, we've always done it this way. And so this is the cost. Well, is our team really the most efficient with how you're doing it right now? Or is there some savings, some time savings, which equals money savings for you? And so if you're feeling like I can't change anything about my situation, well, I would go look at labor efficiency. Let's see, what can we do from a process standpoint to improve our process to bring down our cost of goods? Cool. Sometimes this might be you are spending your time on things you shouldn't be spending them on, and your time is better spent on other things, and you should hire someone to be doing some of what your job is right now. In fact, that often ends up being one of the biggest things, is that owners do too much on their own. And so their time cost in this labor is actually a huge drag on the business. There's a great book called Buy Back Your Time by Dan Martell that if that's a thing for you, I'd really recommend that. We sit down with our clients to look at how should you be spending time versus what should we be hiring off, and does it make sense, right? This question of how can I afford to hire this thing off is one of the most common ones that we get. And it really does make a big difference when you look at it from the perspective of, if every dollar of your time, or if every hour of your time is worth $100 to the company, but you're doing $10 an hour tasks, then how can we afford not to hire that off? So cost of goods. This one too kind of comes into team compensation. We do a lot with team compensation and how we make sure that we're hiring people and planning for hiring with profitability in mind. But this is the fourth lever. Okay. Last one here under our sort of P&L review of things is our expenses, right? All this other stuff that's coming out. It might be called overhead. We call it baseline burn. Then there's these unplanned costs as well. So the first thing that I'm looking at in my business when I'm going through this is I do a quarterly review of my profit and loss statement, or I actually go through the bank account because profit and loss doesn't show all of my individual expenses, but I'm going through and looking at what are the big rocks in my expenses? What are the biggest items, and do I need them? Or has my business changed such that I can either bring those down or be more efficient with those expenses? Okay. But a couple things that we can look at with your expenses if you feel like, man, I might be spending a little bit too much. One is we can shop around, right? We looked at that before. As we shop around and look at different pricing, maybe there's something out there that can do the same thing for less. The other one is maybe I can pay up front, right? Maybe there's a yearly bulk discount where if I buy X software on the yearly plan, it saves me a whole bunch of money. In some cases, that can work for people. Third option is to really look at this, what we call expense creep. Y'all know that there's stuff that you sign up for that you maybe didn't intend to keep using, but it stayed on there. I was completely shocked in the first year and a half of running a business. We had expense creep both in the business and personally. And as I was sitting head down, focused on growing the business, I didn't realize that we had a lot of personal expense creep happening. And when I kind of took my head out of the sand and I looked at our personal expenses, it's like, wow, how are we spending that much on all that crap? And it was just that the expenses crept up on me because I wasn't being intentional about it. So I recommend quarterly look at this. And every quarter we go spend 15 or 20 minutes looking at what expenses are creeping up on us that I need to go cancel. Okay. Oh, and just ask myself, is it really the best use of my time right now or of my money? And this is a big one that a lot of owners just don't pay attention to, but it happens really frequently. Cool. Expenses. All right. So everything above here was if we are net negative in our profit and loss statement, or if we're break even, or if we're not as profitable as we should be, we're pulling one of those 5 levers. Okay. We're either going to go look at our pricing and adjust our pricing and our bundles and our offers, or we might be looking at our amidst our different offers or products or services, which ones are low margin versus high margin. We've got some really cool tools that help with that. Or I might need to adjust my payment terms. Now, this one can show up. It depends on if you're doing accrual or cash basis accounting. If you're accrual basis accounting, but you're collecting money with a big lag, then this is a really big one. The third one was sales volume, right? And looking at acquisition versus fulfillment. The fourth was cost of goods, and the fifth was expenses. The last couple now are after the profit and loss statement. And this is really important if you feel like my P&L looks good, my profit looks fine, but I don't know where the money is going. This is where we start looking. One of the first places is taxes. It's one that most owners don't pay attention to or plan for well enough. And when I'm talking about taxes, I'm primarily talking about your personal income taxes. Profit that's flowing through to you as an owner, you're paying taxes on that. One of the easiest ways to start to adjust this is just by having the right tax structure in place, okay? You've all heard probably that there's this whole S Corp thing. If you are an S Corp right now, wonderful. Make sure that you're making the most of it and that you understand how it works. If you're not yet and you're doing north of about $50,000 a year in profit, it's worth talking to your tax advisor about it, okay? We won't get into tax structure today. We do a lot on taxes with owners. But then the second one is if you have a business where you have a lot of assets that you can depreciate, then we've got to really understand, hey, how much depreciation can I expect this year? And that helps us plan for taxes a lot better. And if we've got some businesses that have so much depreciation that they don't even need to pay anything in taxes. And if you have no clue what depreciation is, it's a topic for another day. It's basically when we have big expensive stuff that we buy, like a car or big equipment or a property in the business, we get to slice up a little bit of that cost each year to take as kind of a business write-off, okay? That's depreciation. And from a tax standpoint, I just see people not being aware of how taxes work. And so they end up with a giant tax bill at the end of the year. And this is by far our most common pitfall that we see, is that business owners don't plan for it. And so they might have their most profitable year ever. And this is something to especially watch out for. If you're moving from maybe the last few years you weren't as profitable and now you're a lot more profitable, this one will sneak up on you and you will hate life come next April, because you'll have this giant tax bill and you thought you were doing great. And all of a sudden it's like, ooh, wow, where did that come out of? Completely came out of left field. Plan on it. So we recommend that business owners save 30% of profit for taxes, okay? All right. Next one here, as we're wrapping up, is debt payback. I want you to think about when you get a loan from the bank. Let's say you get a big old business loan. You get a $100,000 loan. That $100,000 comes into your bank account as cash, but it is not revenue or sales on your profit and loss statement, right? We don't pay taxes on loan money. So because it comes into our bank account and it doesn't show up on our profit and loss statement, when we pay that money back, it also doesn't show up on our profit and loss statement. And this kills a lot of business owners. If they've got loans, whether it's old credit card debt or other types of loans, when they're paying back that initial amount that they borrowed, we call that the debt principal. When they're paying that back, it doesn't show up as an expense. And so this is after your profit and loss statement. And we'll see sort of the chain of how all this money flows here at the end. This is all after tax money. Like you got to pay taxes first, and then you get to pay your debt. And this bites a lot of people, and it gets them in this really vicious cycle where now all of a sudden they're in a ton of debt and they have to pay that back. Now they don't have enough money to make their next payroll. So now they got to go get more debt, and it's a vicious cycle. It's often because they didn't get the first ones up above down right. And so this is why we have these in this order. But there's a couple things we can do with the debt. So if you've got a lot of debt right now, whether it's on the personal side or the business side, we want to look at a couple key things. Number one is the terms, right? So what is our monthly amount? And the biggest one that really affects this is payback time. So if I have a 30-year loan, my monthly payment might be a lot shorter. right? Versus if I have a 12-month loan. And so as I'm looking at my debt, I might see, gosh, do I have a really crappy 6-month loan that I got from On Deck Capital or some other lender? I see people who are, we had someone with a 75% interest loan. They didn't realize it at all. 75% interest for a short-term loan. It was just killing them. And I can't remember if theirs was weekly or daily paybacks, but it was rough. It was really, really rough and short payback periods. Yes, it is legal. I can't believe it is. And it's because the loan business is kind of the Wild West. The faster you get access to that cash, the worse of a deal it is. So if you go and you get a loan, they say, "Oh, we can get you, we can get you paid out tomorrow. We can get you, we can get a loan funded for $100,000 tomorrow." Big red flag for me that's probably a terrible loan with terrible terms. So terms are important. The second piece of debt payback is you can look at, might I be able to consolidate this? So there's a couple different ways you can do this. There are actual consolidation loans where we might take loans that are, if we have a bunch of them and we've got, a 30% loan, we've got another 20% loan, we've got an 18% loan. Maybe we can go wrap those up into one that ends up being a 14% loan with better payback terms. And that actually ends up making sense from a cash flow standpoint. Totally might be worth looking at. Okay. There are a lot of people right now. We have a number of clients who are actually getting SBA loans. If you want to look them up, they're SBA 7A. That's the Small Business Administration. SBA 7A loans that in some cases, people have been able to use to consolidate other debt. There's lots of rules around whether or not you can do this. I'm not an expert on SBA loans. I just know that it's something you might want to look into. They're harder to get generally, but, and there's a few more hoops we have to jump through. It takes longer. But remember, the longer it takes me to get money, the better the terms are, most likely. And so there's some options around here. And we've got people that are getting like 12% interest loans or lower on really long 20 and 30-year terms. And they're wrapping up a lot of their shorter term debt into longer term stuff with much better terms, freeing up a ton of monthly cash flow. And might they pay more in interest over time? Yes, they might. But from a cash flow standpoint, it might make more sense. And so you've got to weigh pros and cons with this one. The other thing is we see a lot of people with credit card debt. I'll just tell you, there's a lot of options for, even something as simple as doing a balance transfer, where let's say you've got $20K on a credit card at, they've got their crazy, like, I don't know, let's call it 25% interest, right? Maybe that's on the cheap side. Well, there might be a 0% option, which a lot of credit card companies have. They'll have a 0% for 12 months. And what they'll offer is a 3% balance transfer fee. It might make sense for me to go look at this and say, would I rather pay the 25%? Would I rather pay the 3% balance transfer fee and then have a year to pay the rest of it off? That might make sense. Or there's a bunch of cool stuff we can do around this, but the debt payback is such a sneaky one because people don't realize it's not showing up on your profit and loss statement. And so it's coming out after that. Debt payback is probably what ends the most volume of businesses. They don't understand how debt works, so they get into more and more of it. They didn't have the rest of their stuff fixed from up above here, and they think that this will work. I'll just tell you, in many cases, if you are finding yourself needing to get debt to survive from a cash flow standpoint, it is a Band-Aid solution that simply kicks the can down the road to buy you time. But if you don't change anything else, nothing else will change. And it will just get worse and worse and worse. So don't let yourself fall into the debt spiral. All right, now let's look at owner pain. We kind of wrap up here. The ninth one we'll do in just a second, but I want you to look at how money flows in your business. Okay, so income comes into your bank account here and something comes out, right? All our expenses, cost of goods and expenses go out. So here's my income, here's my expenses going out, and then I have profit left over at the end of the day, right? So that's what we saw. That's what we saw up here on our P&L, right? If we go back up to the top, here I had all my income coming in. Then I had all of my cost of goods, my expenses, and boom, there's my net income, or in other words, my profit, right? So all that happens first. Next, immediately after that is taxes. because you have to pay tax on that profit, right? We're going to assume a 30% tax rate. And I know that sometimes we've got people who are C Corps probably in here. We've got people who are S Corps, people who are LLCs, maybe even some sole proprietors. I know that this can change generally based off how your business is structured and if you have assets that you can depreciate and your personal situation. But as a general rule, that 30% of profit, we gotta plan on that. Now, is it realistically lower? Yes, in many cases. Sometimes it's higher, but this is a good sort of starting spot. And when we're working with clients one-on-one, we go figure out for their specific personal situation, how much do they need to save for taxes? And when you start having business partners involved, it gets a little bit messier. And then we have to factor in for both partners how that works. So we actually have to spend quite a bit of time on taxes and figuring this out for business owners. But the taxes go out, then we get to pay back our debt principal. Because Uncle Sam doesn't care if you list 100K of profit, let's say, in a year. Uncle Sam doesn't care that you had to pay 50 of that to debt principal because it's not a business write-off, right? We already looked at that. So Uncle Sam says, well, I don't care that you don't have cash in your bank account. You listed this profit. So you have to pay these taxes. And so you can have a net positive, a positive net income or positive profit on your profit and loss statement and be negative, net negative from a cash flow standpoint. More money going out the door than you have coming in. That can absolutely happen. It often happens when we've got a lot of debt. Then after that, we also have paying yourself as an owner, right? Now, I'm not talking W-2 salary. That kind of comes out if you're a W-2 employee of the business. Some of your salary comes out here, right? As a business expense. But for owner distributions, if you're an LLC or for the owner distributions that you're putting out as an S Corp owner, that's not a tax write-off, right? That is not up here in the expenses. And so that is post-tax money. And do you think that that your bank is going to say, oh, I'm so sorry you don't have money in your account to pay your loan? Yeah, that's just fine. No, they want to get paid first, right? And then you get paid after. And then realistically after that, then we move to business savings, right? So business savings ends up often being the last. I see a lot of business owners who put themselves last and they'll get slim pickings. I'm a big fan of, if you're running the business, we got to make sure that it works for you financially first. So in fact, the way we work with business owners is we would sit down together and we would reverse engineer, what does the business have to look like in order for you to take home exactly what you want? And this owner comp actually ends up being the basis for all of the rest of our planning as we reverse engineer everything else. So from a cash flow standpoint, we need to make sure that the business can actually afford to pay you as an owner what you are trying to take out of it. We had a business once that, as we looked at things, they had a net positive profit and loss statement, right? So we looked at their profit and loss. It looked good. We had net positive. However, they had a ton of old debt that they were paying off. And then they were overpaying themselves as owners. And they were not saving enough into business savings. And so they were seeing their money go down and down and down and down in their bank account. And then guess what they had to do? Oh, we got to go get another loan. So they went and got another loan. And then guess what we had to do? Down and down and down and down. They came to us and said, I don't know why this isn't working. My profit and loss statement says I'm good, right? My business says it's profitable. My bookkeeper says I'm profitable. My accountant says I'm profitable. I don't get why my bank account balance keeps going down every month. Well, it's because you don't understand cash flow in the business. And sometimes owners can overpay themselves at the detriment of the rest of the business. And so in fact, then they have to go get loans to cover the rest of things. And they're actually just living off loans. We do not want to do that as a business owner. Again, loans are a Band-Aid solution that's temporary. We got to change something up above the pipeline here. Either we've got to be able to make more income, change our cost of goods or expenses, and to be able to increase our profit. Maybe it's doing some tax strategy stuff. We have people who save tens of thousands of dollars by having the right tax strategy in place and by understanding what to look for and how to appropriately challenge their accountant. Because I'll tell you, accountants can get this stuff wrong. It's the old saying, garbage in, garbage out. If you are giving them garbage in terms of the information that you're giving them about your business, maybe it's your books and you're giving them inaccurate books, then they can only do what they can with that information. I had a very painful experience with this. Let's see, this would have been like 3 years ago, maybe it's 4 years ago, 3 or 4 years ago. I did not understand how the complex bookkeeping worked in my multi-entity setup, and I double reported some income on my books. The bookkeeper didn't catch it. The accountant didn't catch it. Guess what? I overpaid by $25,000 in taxes, and I didn't catch it for a year and a half because I didn't know what to look for. And then all of a sudden, when I went to go get our construction loan for our house, we realized, hey, I knew something was off, but we had a bunch of money moving around that year. And I finally found it. It's like, oh crap. Luckily, we were able to go refile those taxes. But I thought that the accountant and the bookkeepers would just have me covered. But I had given them garbage in, so I got garbage out. And I overpaid by $25,000 on taxes. This stuff costs you real money. Not understanding this and just expecting that everyone else will cover it for you can cost you big time. So don't expect that everyone else is going to solve this stuff for you. The final one here is business savings. Okay. It's how much we're saving in the business. For most business owners, you need to be saving somewhere between, at a minimum, 1% to 5% of revenue or sales into the business for reserves. And we want to build up to eventually have 3 months. 3 months is the goal, 3 months of operating capital in the business. If you don't have reserves, then guess what happens? You got to go start getting into debt, honestly. And that is often what starts that cycle, is that people just don't save into the business enough. And so managing this business savings ends up being important. So I told you this would be an hour. We are exactly at the hour mark. As a quick review, we just covered pricing and how you're going to adjust your pricing and offers, and how you're going to look at your margins and focus on higher margin versus lower margin things. We talked about payment terms and how you're going to make sure that you can get paid sooner. We talked about sales volume and adjusting that, and that sales volume alone will probably not change the business in its entirety, even though most people think that's what they need. We talked about adjusting cost of goods and labor and potentially hiring out things that you're doing right now. We talked about expenses, and then we talked about taxes, debt payback, owner pay, and business savings. I want to know now, what do you feel like your next step is in your business? Out of all of those, will you put in the chat, which is the one that you need to go focus on next? You just spent an hour here with me. How are you going to go make this hour actually worth it? Because I don't know what you charge per hour, but my guess is your time is not free. And so you know that your time has been inherently valuable while you've been on here. But it's most valuable if you go actually act on the new insight that you've hopefully just gotten. So where do you need to go focus next in the business? What's your next step? And as you're putting it in the chat, I'll just say, if you feel like you want help with this stuff and you're like, ooh, this was good, but I know that I need to, number one, I need to get a better handle on my finances. Number two, I need to make sure that the systems that I have are set up and working well. Even if I have an accountant and a bookkeeper, I need to make sure that I'm getting them the right information, that they're understanding things right, that I'm not getting hosed on the tax side of things, that my debt payback is good. And maybe most importantly, that what I can pay myself as an owner meets what I need. Well, that's what we do inside of our program, CEO Finance Academy. We sit down one-on-one with business owners over a period of months, and we get a real handle on, number one, the clarity piece of your business. Where are you really at financially? How much do you need to make in the business in order to achieve all the goals that you want? We'll sit down and we'll do an audit of what you're doing financially. We'll put another pair of eyes on your books and see, where are we missing things? I find so many errors in books. We'll look at the tax side of things together and help you understand what's actually going on from a tax standpoint. We'll get creative with debt payback and how we need to manage cash flow from that perspective. And then we'll give you a framework for how to make sure that you're paying yourself appropriately so that you can even out the crazy roller coaster within your business. And then on top of that, we'll make sure that you've got the solid systems set up from a business standpoint. But ultimately, it's about empowering you as a CEO to understand the financials of your business, to be able to make clear, accurate, and most importantly, the right decisions about where to take your business next. So if that's something that you want access to, you should hop on a call with our team. We'll sit down for a quick 15 minutes. We'll see, hey, is this a fit for you or is it not? If it is, we'll sit down together on a deep dive call, and you'll sit down with our team to figure out where you're really at financially. What does the next step need to look like for you? And if we can play a part in that, show you what that looks like. If you want that, let's see, I don't know if Will's still on. I can't see everyone else. Scott is still on. Scott, will you go find the link to your calendar and pop it in here on the chat, or we can just send people directly to ceofinanceacademy.com.
I got it.
Will, you got it?
Yep.
Beautiful. So then as Will's dropping that in here, Jordan says sales volume and owner pay. We got debt pay down for Tokes. We've got second business savings. Love it. Taxes and expenses for Trish. We got collapse profit time. Yeah, collapse in that time. Acquisition. David, you should read that book that I mentioned on Buy Back Your Time by Dan Martell. Sales volume, good stuff. So if this is something you want help with, I'd really encourage you to visit our website. You can go to, if you're on the replay, it's ceofinanceacademy.com. You can find the link on there, or we drop it here in the chat as well. We'll probably put it under the replay here. And you'll sit down with Scott and he'll say, hey, here's where you're at. Let's look at what your next step needs to be. And we work with business owners who are really serious about taking ownership over their finances and getting serious about making the business work for them rather than the other way around. And then we sit down with you one-on-one to actually get this stuff done. All right. I went 4 minutes over. However, I've opened up a few minutes on the back end here for any Q&A. If there are any questions, feel free to unmute yourself. We could talk through this for the next 10 minutes or so. I know I just went like a million miles an hour for an hour. So if you got any questions, feel free to unmute, lay them on me, and I'm happy to talk through this. I know a bunch of you have to run because there's clients and patients and all that, but happy to answer any questions if you've got them. And I'm curious, was this worth the hour of your time sitting down? This is something that we want to do more of. We've got a bunch of different topics that we're going to cover, but I'm curious if this was useful for you. And yeah, any last questions as we wrap up? Cool. Sweet. Go ahead and, it said it would be 30 minutes. Oh, well, my bad. I was planning on an hour. Well, there we go. Next time I'll have to cut it in half. Double the value. We just over-delivered for y'all today. All right. Thanks y'all for being here. We appreciate you. And we'll be putting out another one of these soon. The replay will be going out to people via email, and we'll catch y'all on the next one. Bye y'all.